Hey, it is 12 noon on Wednesday, which means it's time for another episode of Ask the Instructor. I'm John Carismo, and this show is brought to you by the Tampa School of Real Estate. If you're interested in starting or enhancing your career in real estate, make sure to visit www.tampaschoolofrealestate.com. That's tampaschoolofrealestate.com. You can also give us a call. We're ready and willing to answer any questions it is that you have, and that phone number is 813-928-0106. Again, 813-928-0106. Folks, the reason why we started this Ask the Instructor show is we were looking for another way to help support our students, whether it's after they're taking the class, whether they took the class online or in one of our classrooms in the Tampa Bay area, or maybe you're just looking for something to brush up on when you're studying for your exam. We started these shows every week on Wednesday at 12 noon Eastern Time to help out our students, because at the Tampa School of Real Estate, there's no end really to what we'll go to for our students. No other school that I've seen at least will go as far as we do for our students. No other school is doing as much for our students. We want to see our students succeed not only on the exam but also in the real world. The second reason why we started this show is because there's more than just passing the exam. A lot of this information that we talk about, yes, you do need to know it to just get your license, but it's going to be information that comes up on a daily basis. If you ever heard the saying before, everything you learned in your real estate course, you're never going to use it again, that's just completely false. There's going to be some stuff that you don't use on a daily basis that's not part of your daily skills, but there's stuff that you need to know about if you do want to be successful in your real estate career. That's your ultimate goal, I'm sure. That's our goal, is to help all of our students be successful not only on the exam but also in their career. That's the reason why we have Ask the Instructor. Now again, these shows are live every Wednesday at 12 noon Eastern Time, so you can tune in. Feel free to share this with your friends if you have study buddies, people that you're trying to study with, or maybe you're just on your lunch break at your real estate office and you're looking to kind of brush up on some of this material, to stay sharp, to stay on top of your game. We really appreciate it if you share this out to your friends and family. It's surprising how many people are actually involved in real estate, and I'm sure they're going to be able to take away something from today's episode. Even if you're just a homeowner, even if you just own real estate, this is going to be a helpful episode because it's going to help you better understand. And even if you don't own real estate, if you do any sort of financing whatsoever, today's topic is on mortgage amortization. And before I truly understood and fully understood mortgage amortization, interest was really confusing. I'm sure interest is really confusing to a lot of people. The financing industry, it's not a simple industry. There's a lot that you need to know to be able to really break down and understand how much it is that you're paying for the cost of this money. We're talking about it specifically with real estate and mortgages today, but again, like I said, this is going to be helpful for anyone that either owns a home or that does any sort of financing. Like I said, once I started really working with mortgage amortization and breaking down amortizing and figuring out what money gets allocated where, I really understood interest a lot better. And when you understand interest a lot better, not only are you going to be able to better explain this to your clients, but if you're purchasing a home yourself, you can now have a better idea of where this money is actually going for and make a more informed decision about how it is that you're allocating your money. So it's good stuff to know at the very least, just so you have an awareness of what's going on with this. It's going to really help you better understand interest altogether, whether it's for a mortgage or some other type of investment or purchase it is that you're making, because a lot of these same rules apply for how interest is calculated for not only mortgages, but a lot of other aspects of the financing industry as well. So again, if you're just tuning in today, we're watching, today's episode is based on mortgage amortization. So before we start talking about some math and breaking down this amortization, we need to really understand what this kind of breaks down into. So if you own a home and you have a mortgage payment, what it is that money is being allocated to every single month when you're writing a check. Well, you may have heard the expression before, whether it's something your mortgage lender told you, your real estate agent told you, maybe it's somehow broken down in your statement that you receive every month, but you've probably heard the term before of PITI, or PITI, P-I-T-I. So PITI, these are basically the four main components that you'll typically find in some sort of mortgage. Now, the ones that we're going to be dealing specifically with here are just this P and the I. So what these are, because it's definitely important that you know the breakdown of each individual element here for mortgages. We have our principal and our interest. So these ones, we have our principal and our interest. We'll go ahead and So our principal and interest, and this is pretty much in any sort of finance purchase, you're going to find these two elements. Now, when we're talking about mortgages, we have these additional two elements of taxes and insurance. Now, taxes and insurance, these aren't always required here, but these are the extra two parts, taxes and home insurance. So let's talk about why these would be factored in with your mortgage payment. Why does the financier of your real estate care about the taxes or the insurance, and why are they trying to collect the payments for your taxes and insurance? Because ultimately, the mortgage lender is not going to be the person that's collecting the money, it's not going to be the one that's charging you the money for these taxes or insurance. Now, why would the mortgage lender want to charge these? And if you guys want to contribute to any of this stuff, if you have anything you're not unsure about as we're going through this, or anything that you want me to talk about, again, put it in the live comments. I'm monitoring both the Facebook and YouTube live stream, so if you're watching on our Success Center or if you're watching on Facebook, I can see all your comments right here. So if there's something you don't understand, maybe something you want to add to this here, we'd love to hear from you. So definitely put that in the comments. And if you're liking the stream, if you're liking what we're doing for you, hit the like button, the love button, whatever reaction you want to put in there. Maybe you're angry with this. Maybe you're angry with real estate math. Go ahead and put an angry in there. I love seeing that feedback coming in with that. So these taxes and insurance. Now, why would we be factoring these in when we're dealing with a mortgage? The reason is, so in order for the bank to loan you this much money, because when we're talking about a mortgage, you're talking about probably the largest piece of financing someone's able to obtain. Compared to any other type of loan, any other sort of financing out there, it doesn't really matter what it is that you're purchasing. A home mortgage is typically going to be the type of financing product where you're able to get the largest amount of cash. And that's a huge advantage to purchasing real estate, is that you're able to highly leverage, meaning you're highly borrowing money for this property. So with taking out a mortgage, you're probably able to get more money for that mortgage than you'd be able to get for any other financing you do anywhere, whether it's credit cards, personal loans, student loans, whatever it may be. The mortgage is usually where they're willing to dole out the most amount of money compared to your metrics, your income, and things like that. Now, why are they willing to do that? The reason is this is a secured asset. So this is something where you're basically promising, when you sign off on your mortgage promissory note, when you sign off on this note, you're saying that the bank could take your property, the lender could take the property in the event that you do not pay back the mortgage. So I make payments to you. If I stop making payments to you after whatever the terms are in the promissory note, you could take my property through a foreclosure. So understanding that concept, that the reason why the lender is loaning you so much money for this property, the reason why they're financing so much money, is because it's secured by the property. And even to this day, even after the whole mortgage crisis and everything that's gone on, they still highly rely on the security, the collateral. The hypothecation is what we call this process of giving up the property as security for the debt. So if anything happens, if there's something going on where you're not meeting the terms of your promissory note, the lender could go in and they have recourse where they could take the property. This allows the lenders to loan out so much more money than if it were an unsecured type of investment. That's why for a credit card, you're not able to get a $300,000 limit credit card, but you might be able to get approved for a $300,000 mortgage loan. So that's highly secured with that. So this is where the taxes and insurance come in, because this could complicate things for the lender. This could make it where maybe the lender can't take that property back, because if you're not paying your mortgage, you might also not be paying your property taxes. And if you're already taking the course, you might remember that the number one priority lien is property taxes. And that's the taxes that we're talking about in the taxes and insurance portion of the PITI. So the taxes here, this stands for property taxes. So the reason why the lender wants to allocate basically the property taxes as part of your payment is because they want to make sure that the property doesn't get lost through a tax deed, that it doesn't end up getting auctioned off for back property taxes. Because if the property taxes aren't paid, it doesn't matter when that lien is filed, the property taxes are automatically the number one priority. So if the mortgage lender has money outstanding on the property, they're second in line to the property tax lien on the property. So this is a huge difference. Nothing could overtake property taxes. So if the taxes aren't paid, the bank, not only can the homeowner lose out on the property, but the lender could lose out on the property as well. So in a lot of cases, the lenders will also require this what they call an impound account. So this part here, and this isn't going to be broken down in our amortization later, but it's important to know that this is not included in the amortization. This is something separate, and we call this an impound account. Impound, and it's also sometimes called an escrow account. That term escrow meaning to hold money in trust, because that's what this lender is essentially doing with the taxes and insurance, is they're holding this money in a trust fund. So when the taxes do have to be paid, your property taxes become payable, that's where the money's already set aside. You've been paying 1/12 of your taxes. They basically take your entire year's worth of property taxes and break it up into 12 monthly payments, and this makes up your total payment that you're paying in most cases as your mortgage payment. So they're taking that tax portion and they're allocating this out into a special impound or escrow account to be set aside, so when the property taxes are paid, the property taxes get paid. There's no chance the homeowner loses the property due to taxes, and there's no chance the lender loses the property due to back taxes. So it's a good way for the lender to ensure that the property taxes are paid, and that way they don't lose out on the security that they have for loaning out such a large amount of money. Now, the other aspect we have here is our insurance, and this is also broken into the impound account. And typically, if they're going to have you do your property taxes, they'll have you do the insurance as well, because this is another reason why the lender could lose out on the property. Now, a typical statistic is that a property is about 80% building value. Now, that could vary based on the property. Maybe it's a really expensive lot and the building isn't so nice, or the house isn't so nice on this property. But typically 80% of your property's value is made up by the building. So especially living here in Florida, in Tampa, knock on wood, that we've been pretty unscathed by some of these massive hurricanes, but there's these massive hurricanes that could come through and wipe out a property. Maybe it's a fire, maybe it's a flood. We definitely don't have a shortage of flooding, especially in the South Tampa area that we have down here. But this building value represents such a large chunk of the property value, and if that building gets wiped out, say it gets entirely wiped out, it gets entirely taken off, and all that's left is just the foundation and the lot, that's going to be a huge loss, not only to the homeowner, but especially to the lender if it's not insured. So as part of this impound account, not only do they want to make sure the taxes are paid, because if you don't pay the taxes, that's where the local government is going to come down, the tax assessor is going to come down, and it's going to go through that whole property tax auction process. It won't be auctioned right away, but it's going to go through some steps to eventually get to that point, and the lender could lose the property due to that. But the lender could also lose out on the property if the property gets almost completely destroyed. Even if it's only partially destroyed, the lender wants to make sure that the property's insured. So in the event that there's some sort of natural disaster, whether it's a fire, a flood, a hurricane, massive winds, or whatever the reason it is that you have insurance for, that something could happen to the building, that building is protected. So the key thing the lender wants to make sure is not only that the taxes are paid, but also that the insurance for the property is also paid. Most lenders require, I say most, but all lenders pretty much are going to require the property to be insured. And a lot of times they'll have this as part of an impound account, where basically payments are being made towards this impound account for not only the taxes, but also the insurance. So you would take, let's say if it was $1,200 a year in taxes, that would basically break down to $100 a month. If it was insurance, let's keep it easy. Let's say it's also $1,200. Then that's also going to be $100 a month for our insurance. So on top of our principal and interest, we also have our taxes and our insurance that have to be paid every single month as well if there's an impound account involved. Now this portion over here, the impound account, the taxes and insurance, that is not involved in amortization. Amortization, we're only doing principal and interest. It's very important that you understand that these are separate from the principal and interest, because if you try to include these with your amortization, your number is going to be all over the place and you're not going to have the right information. It's very easy to calculate out this impound account. You just take the total tax for the year, divide it by 12, and you take the total insurance for the year and also divide that by 12. So in this example here, if we had $1,200 a piece, $1,200 for property taxes and $1,200 for insurance, that'd be an extra $100 a month for our taxes and an extra $100 a month for our insurance. But that's just calculating out how much money is going towards this impound or escrow account for the taxes and insurance. That is not included in mortgage amortization. So very important that you understand all these concepts. If you're watching the recording for this and you didn't quite get all of this, go back and rewind and make sure that you're catching all of this here for what is broken down, because this is going to be very important that you understand how this is broken down before we get to the amortization, because especially if you're taking this on the exam, they like to include this information in here when you really don't need this information for the question. That's a great exam taking test tip, is anytime you're taking the test, don't always think that you have to use all the numbers. In the real world, all the numbers mean something, but on your exam, they might put in some extra information that you don't need to know. So the first step is identifying the true information that you actually need out of the problem. So when we come back from this next break, we're going to actually go into a little bit more of the breakdown of the principal and interest, where we're going to actually divide this out for every single month payments for how much is going towards principal and how much is going towards interest. So stay tuned. I'm John Carissimo, and you're watching Ask the Instructor.
Did you know that the Florida real estate license exam usually averages a 50% pass rate? The good news is that you have the opportunity to be a part of the passing 50%. The Florida real estate exam covers three main areas: real estate principles and practices, Florida real estate laws, and general real estate laws. Our exam review class focuses on reinforcing the key concepts of these areas in a fun and engaging way. You'll also learn valuable exam strategies and get lots of practice with real estate math problems. This course includes our exam prep textbook that contains over 600 practice questions to help you prepare for the state exam. And we're so confident that we have the most comprehensive exam prep courses in Florida, we back all of our students with our exclusive 1-year retake guarantee. Our class sizes are limited and tend to fill up quickly, so reserve your seat today. Registration is easy and just takes a few minutes on our website, tampaschoolofrealestate.com. You can also stop by our administration building or give us a call at 813-928-0106. Our advisors are standing by to answer any questions you have about preparing for your Florida real estate license exam and starting your exciting new career in real estate.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, and welcome back to this week's episode of Ask the Instructor. I'm John Carissimo, and this show is brought to you by the Tampa School of Real Estate. Over the break, that commercial was talking a little bit about our weekend review classes. So if you've already took the course, but you're just looking for some refresher, you're looking for a really good cram session before you go and take your exam, these classes are perfect for what you're looking for. You could basically take the course, and then if you schedule your state exam or even your class exam right after you take this weekend review course, you're going to be in the best shape to pass that exam on your first try, or if you've tried taking it before, that's a good point to be in. It's a 50% pass rate usually about statewide. Sometimes it gets even lower than that. But the reason is that this isn't really a hard exam. Now, how is it not a hard exam to pass if there's a 50% pass rate? It's not really a critical thinking test. It's not an IQ test to see how smart you are. It's a test to see whether or not you know the information, the real estate laws, the real estate principles, the practices, the math that's involved in this course. So if you take the course and you really digest all the material, you go take your exam right away, you should be in great shape to take it. But maybe you want a little bit of refresher, you want a cram before you actually go and take your state exam. Check out our weekend review classes. We have them all over the Tampa Bay area. It's Saturday and Sunday all day. It's a really great course. We get calls and emails and texts and phone calls from people all the time saying, hey, I just took this course and I just passed my exam. It's a really great cram session, so I definitely recommend that. But let's get back into this amortization here. So we talked about before we went on break the taxes and insurance. If you're watching the recording on this and you don't understand this breakdown, go back and rewind this and rewatch that. That's the great thing about this Ask the Instructor show. Yes, we do it live, so you guys could comment in with questions, stuff you don't understand about what we're going over here, but it's all going to be completely recorded and available on our Success Center, tampaschoolofrealestate.com/success. Make sure you check that out because you could log on there and watch this episode. You could watch past episodes, and that alone is really a great way to review for your exam and make sure you're mastering all this information. So we're going to be talking about this principal and interest portion of this. And now, like I said, this amortization here, once I started working with some of these real estate amortization calculations, I understood financing so much better. It really made everything a lot clearer of the true cost of money. And whether it's you're a real estate professional and you're trying to help your clients better understand how this money is being allocated here. Maybe they don't trust their mortgage lender so much and they're like, hey, look, tell us what's really going on with here. And that's a great place for you to shine with this information. Or maybe you're looking to buy a house yourself and you want to see what this really equates out to try to figure out whether or not it makes more sense to own or rent a property. So this is all very helpful. Even if you're just buying something with a credit card, a lot of the same concepts are going to apply here. So this is really going to help you understand financing in general a lot better. So now when we're dealing with amortization, we're not dealing with the impound account. So that's important that you know that the impound account, your taxes and insurance, are not factored in the amortization of a mortgage loan. The reason why is because that's a very simple calculation, just like we did. If you missed that, go back and rewind through it. You just take your total year's taxes divided out by 12, your total year's property insurance divided by 12, and that gives you how much money needs to go into the impound account every single month. So that way when the taxes need to be paid, the money's there. When the insurance premiums need to be paid, the money's all there. Now, for amortizing the mortgage, there's only two elements that we're going to be looking at here, the principal and the interest. Now, not all mortgage loans are going to require that impound account. There's some lenders that are like, hey, look, the taxes and insurance, that's your thing. You're going to promise in your promissory note that you're going to pay those, but we're not going to hold your hand through it. We trust you to pay your property taxes. We trust you to pay your insurance. So you might only have just principal and interest that's going as part of your mortgage payment every single month. And that's what we're going to be looking at in the amortization here. So with amortization, what this is meant to calculate out is how much money is going towards principal and how much money is going towards interest every single month. So your payment plan could be the same. They call that a level payment plan mortgage. So a level payment plan mortgage means same payment every month. So that's the same overall, the same check that you're writing, the same direct deposit that's being made every single month for this. So how does the principal and interest change if you're making the same payment every month? That's what our term amortization basically means. So amortization, if you actually look back and you see how I kind of capitalized this M here, and it's meant to kind of break down the prefix of this, of mort. This term of mortgage and amortization, this basically means to gradually kill, if you look up the root of this word, is to gradually decrease. And what we're gradually decreasing, you know how I like to use these little graphs here, so we'll go ahead and pop one of these in here. So we have two colors here. We have our green. The green is going to represent our money that's paying down our balance. Our red is going to represent our money that's going towards the interest towards the bank. Here we have year 0. Let's say we're dealing with a 30-year mortgage, so over there we have year 30. Now the way this works with amortization is this green. Remember, green is going to be the amount of money that's actually paying down our debt, the money that's actually going towards paying down our balance, whether it's the balance for the mortgage on a property, the balance on a credit card, the balance on a student loan. It pretty much works the same way for a lot of different types of financing. So this amortization, it starts off where you're paying down a small amount and gradually increases. So in order to make our level payment plan where the payment is the same every single month, you actually start off paying a very high dollar amount and interest, and as time goes on, you eventually will cross where you're paying mostly principal rather than mostly interest. But when you first start off on a mortgage, and this is very important to know, this could be an exam question in and of itself, is that when you start off with a mortgage, you're paying mostly interest on the mortgage. So this is maybe where that question of does it make sense more to own or rent property? And the real estate background I have, you would think I would say that it's always better to own property, but it does depend on the particular situation. And that's what's great about having a real estate license. If it doesn't make sense for your clients to buy a piece of property, you could still get a commission for helping them rent out a piece of property. There's lots of landlords, there's apartment developers that are willing to pay commission to real estate professionals that bring them clients to rent out in their property. So maybe it's not as large of a commission, but maybe it makes more sense for your particular client. It might make more sense to rent. If they're looking to stay there in the long term, they're going to end up paying down more balance. But as you can see, if they're only planning on staying there for a year, they're not going to barely pay down their balance at all. They're going to pay a lot of money in interest, and maybe they'll get some capital appreciation. And that's really the driving force behind whether you want to own or rent a piece of property is the capital appreciation. If you count on the capital appreciation, it always makes a lot more sense to buy property rather than renting property. But if you're factoring out the capital appreciation, you're factoring out how much the real estate could increase month over month, maybe that's where you look at this more and say, hey, well, it's going to actually cost me more money to own the property if it doesn't go up in value, or maybe it goes down in value. Typically, real estate does go up in value, but maybe it's not the best idea always to count on that, because it can take a dip, especially if you're being in there the short term. Anytime you're looking past 5 years, it doesn't matter which way you cut it, it's pretty much always a better idea to own a piece of property as opposed to renting. But there's amortization, and now if you get a low interest rate, this number gets a lot smaller here, where you're maybe dealing with this here. Right now we have some of the lowest interest rates available, so it's a great time to buy real estate right now, even if you're looking to get into it more of the short term. So it does make a lot of sense, but as the interest rates get higher and you're making more interest, typically the capital appreciation goes higher. So we could do a whole session on this of just how it goes back and forth between all of this stuff here. But the more you understand these facts and figures, the more you could look at it for the particular situation, whether it's you buying a home or you're helping somebody buy a home, to help them make sense of this and see how long it is they have to live in the property, or how much capital appreciation it is that they're going to need in order to help make up for this interest it is that they're paying here. And another great thing, because the U.S. government has a lot of solutions to this as well, is this interest is tax deductible. So you take that into account, and now we're talking a great idea to buy a piece of real estate as opposed to renting, because you're getting tax deductible interest. So yes, you're paying all this money in interest, but it is tax deductible. So again, this depends on the particular situation it is that we're dealing with here, but there's a lot of solutions to this, where typically buying property is the better bet. It makes more sense in most cases. Renting occasionally can make more sense if maybe they're just not ready even to commit to something. Hey, if they're renting today, they might be buying tomorrow. Not tomorrow, maybe a couple years, but that's great for you because you help them rent today, you do a great job, you stay follow up, and you stay committed to these people. They're going to come back and use you when they're ready to buy their property as well. So it's not always bad if you're having somebody rent a property right now, because they might not always want to rent a property. They might look to buy property down the road. Again, with a real estate license, you could help them and earn a commission, whether you're dealing with helping them rent or helping them buy a piece of property. So that's what our term amortization means. It means to gradually kill or gradually decrease. So this is a really good way to check your work as you're going through and solving these math problems. You should always be seeing the interest being much higher than the principal at the beginning, but then as you get towards the end of the 30 years, it's going to be almost all principal and hardly any interest. Now that term principal, I've mentioned that a lot, but I don't know if we've quite defined that out exactly what it is, because you could see this in a couple different ways on your exam. You might see the term principal. That's probably one of the more likely terms that they're going to use. So principal could also be shown as loan balance, or it could also be showed as just your balance. It could just be loan amount. This is basically how much money it is that you're borrowing, what that initial amount borrowed is. This does not factor in the interest. The interest is separate, and this is the cost of borrowing money. You could think of this really as of your rent for using this money. You're taking the money from the lender, you're renting the money from them, and the longer it is that you rent it, the more interest it is that you're going to have to pay. So you definitely want to understand these terms. A level payment plan mortgage means that we have the same monthly payment every single month. You could have a partially amortized mortgage or a fully amortized mortgage. If it's fully amortized, that means you completely kill off the mortgage at the end of the 30-year term, or maybe you're dealing with a 15-year term, whatever the length of the mortgage is. So amortization that's fully amortized means you fully kill it off. Partially amortized mortgages means that you partially kill off the mortgage. So that means you get to the end of the mortgage, you get to the end of 30 years, and you still owe a balance. So maybe you still owe $10,000 at the end of the mortgage. That's going to be what we call a partially amortized mortgage, and that payment that's due at the end is called a balloon payment. You can either pay that all right up front there and just hopefully save up enough money to pay that out, or a lot of people will also refinance this out and then extend their mortgage out essentially a little bit longer to help pay down this remaining balance they have at the end. But that's what the term either fully amortized, completely kill, versus partially amortized, meaning that we're gradually, we don't decrease it fully. We gradually decrease it, but we get to the end of the term, we get to the end of the 30 years, and we still owe money with partially amortized. But typically, it's at least for the mortgage amortization math we're about to do, it doesn't matter whether it's fully amortized or partially amortized. That's just when you get to the end of the mortgage, which especially for these exam questions, you're pretty much only going to be dealing with 2 months, maybe 3 months that you'll have to figure out these amortization figures for. Again, our principal, that's just the financing term for how much money it is that we take out, what our initial balance is, how much money it is we have outstanding, how much money it is that we borrowed, and that's completely separate from the interest, which is how much it cost us to borrow this money. So those are our 4 different elements, really, that you need to know in order to amortize mortgages. Now, there's 3 steps and 3 specific pieces of information that you need. So let's start off with the 3 specific pieces of information you need to amortize a mortgage. So the first one that we're going to need here is our balance. And again, this is typically called your principal. So how much money it is that we borrowed. That's the first thing that you're going to need to amortize a property. The next thing that we're going to have to factor in here is our APR, our percentage rate, our annual percentage rate on the property, what our percent of interest may be. And then finally, the last thing you need is the payment amount. So you need the loan balance, how much money it is that you borrowed, you need the rate that you borrowed it at, and then you need to know how much it is that you're paying every single month. And typically, let's say you're dealing with this in the real world, this is a really prime situation where a real estate agent might see something like this, or as a homeowner you'll see this, you'll be presented this information from a lender. The lender says, okay, I'll loan you $300,000 at 5% interest and you'll have a $2,000 a month payment. So those 3 pieces of information are handed to you, and what we're doing with amortization is we want to see how much for month 1 goes towards our principal and how much goes towards interest, how much for month 2 goes towards principal and how much goes towards interest. And there's a lot of great calculators online that calculate this out fully, that does it just like that for you, where it'll show you the whole breakdown of how much principal it is every single month and how much interest it is every single month. That principal number should always be growing larger, the interest should always be growing smaller as you look across all of this here. If you're taking your exam, you're not going to have the leisure of having these fancy calculators that calculate out everything for you. You have to do it the old-fashioned way, but the good news is, although it is a lot of steps that you have to remember, it's really not even a lot. It's only 3 steps, and it's all just basic math. All we're going to be doing is doing some subtraction. We're going to be doing a little division, a little bit of multiplication. So it's all very basic stuff, which we could take somebody who's just in grade school math level, and they're going to be able to solve this if they remember what steps it is that they're going to have to do. So when we come back from the break, we'll actually plug some numbers into this, and we'll actually begin doing a little bit of amortization. Stay with us. I'm John Carissimo, and you're watching Ask the Instructor.
When you look back on your real estate career, you'll remember the moment you decided to begin this journey. The moment when you finally decided it was time for change. The moment when you decided it was time to take charge. The moment that changed the direction of your life forever. Now is that moment.
Hey, I'm John Carissimo, and I'm here to tell you about State of Real Estate. This show is going to be live every Friday at 12 noon Eastern Time, and this is going to be a show for you guys to chat in and get interactive live with us to help mastermind and build your real estate business. So make sure you tune in this Friday at 12 noon Eastern Time. Again, that's Fridays at noon Eastern Time. You can find the links in the description for this video. Look forward to hearing from you on Friday.
After the show, be sure to visit tampaschoolofrealestate.com. Again, that's tampaschoolofrealestate.com, where you'll find all the information you need to start your career in real estate. Also, be sure to check out our Success Center, where you'll find helpful tips for building a successful real estate career.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, and welcome back to Ask the Instructor. I'm John Christmas. This show is brought to you by the Tampa School of Real Estate. If you're looking to start or enhance your career in real estate, give us a call. Phone number is 813-928-0106. Again, that's 813-928-0106. You can also visit us online at tampaschoolofrealestate.com. That's tampaschoolofrealestate.com. You're not going to find another school that does more for their students than us. That's why we do this show every Wednesday at 12 noon Eastern Time, to help our students fully understand and grasp this material even after they've taken a class with us. So if you like the stream, make sure you hit like, subscribe to us, share this with your friends and family, because I'm sure they're going to be able to take a lot away from it, especially with today's episode. We're talking about mortgage amortization. And like I've said a couple of times already on this show, that understanding how the breakdown of this principal and interest goes taught me a lot about financing, and I was able to apply a lot of what I learned here, not only in the real estate space, but also in the other terms of financing, to understand the true cost of obtaining credit, for obtaining money. But as far as taking your exam and whatnot, it's very specific as to how we're going to do this. Again, it's going to teach you a lot of the fundamentals that applies in other areas of financing. So very important to know whether you're a real estate professional, you're a mortgage lender. They're the ones who really have to know about this the most. It could be even applicable if you're buying your own property, whether it's an investment property or it's going to be a property that you're going to live in, or maybe you're just helping a friend make a decision on a property that they're buying, and you want to kind of look at the numbers and be able to crunch them a little bit and understand what this breakdown really comes to. So before we went on break, we talked about these three elements that you need in order to calculate this amortization. What we're figuring out with amortization is how much every single month goes towards principal and how much goes towards interest. Because every time you write a check to the lender for your mortgage payment, there's a portion of that that's going towards principal that's actually paying down your balance. So on month 2 or whatever the next month is, it's going to decrease by whatever that principal amount may be. And then there's the amount that's interest. The amount that's interest is just going to the bank, and this is what they charge for loaning you out this money. So this will help give you a better idea of what this breakdown truly amounts out to be. So let's say that our balance, because we're going to plug some numbers in here now, is $300,000. So let's say we're qualified for a $300,000 loan. So this would basically be $300,000 that's being handed to us. There'll still be some money that's typically required for a down payment or whatnot. There are some programs where there's no down payment required, such as VA and things like that. We'll talk about that on another episode. As far as for amortizing a mortgage goes, let's say our balance is $300,000. And if you're taking this on the exam, it's going to give you these three pieces of information. They're going to be worked into the question somehow and hidden in that question, but they're going to be in the question. And if you want to have some more practice with some of these questions, check out our little exam simulator. You could get in there, and it's got, I think, over 600 questions where it's exam style questions with ABCD multiple choice. It's really great for making sure you can master these types of test questions and pull out the information it is that you need. You could also get our exam review book, that little exam review book. That also has about 600 questions, just a little bit more old-fashioned with pen and paper, but a lot of people like that more. So definitely check those out if you're looking to have some more practice questions. Be careful with what you do for a review, some of the stuff that you find online. Make sure you're getting it from a school that's a licensed school, because there's a lot of misinformation that's out there, especially, not to talk bad about anybody, but if you're looking at a company that provides education across the United States, the laws are very different in a lot of the different states, especially Florida. Florida's like the wild, wild west when it comes to real estate laws. So definitely, if you're trying to get a license in Florida, be careful with what it is that you're using to study. You want to make sure it's current and up-to-date information. These laws change really every single year. So back to what we're looking at here, our APR. Let's say that the percentage rate of interest is a 5% interest rate. Let's say the lenders quoted us $300,000 loan at 5% interest, and let's say that the payment amount is, let's say it's about $2,500 a month. So this is the information that the lender is going to give you, or on the exam that the question is going to give you. It's going to say that your balance is this much, your interest is this much, your monthly payment is this much. And basically what you have to do is use this information to break it down and figure out what the payment is for the first month, how much is going towards principal and how much is going towards interest. For the second month, how much is going towards principal, how much is going towards interest. They might even ask you to go out to the third month, how much is going towards principal, how much is going towards interest. So let's give us a little bit more room up here. We'll go ahead and rewrite this information. Whenever you're taking your exam, I highly recommend rewriting this information so it shows up exactly where it is that you need it. So I would always put this on your scratch paper. So we have our balance. We'll just abbreviate this as BAL, and that was $300,000. We have our interest, which was 5%. And then we have our payment, which was $2,500. So it's really great to write this down on your piece of paper, your scratch paper it is that you're working on, because you could kind of think of this as almost like a little cheat sheet for when you're actually going through and solving out this information here. Keep that glare off there so you guys could see this good. So we have these 3 pieces of information, and overall there's 3 steps that we're going to have to do. So our first step in amortizing a mortgage is taking our loan balance, and this is pretty much the same way interest is calculated out across the financing industry. As you take your balance, you multiply it by the APR, our annual percentage rate. Now this is where most people get lost when they're multiplying by the APR. The reason why this is a little bit confusing, and it's really understanding what this term means. It's an annual percentage rate. So we know what a rate is, we know what a percentage rate is, that's 5%, but now we have to factor in this term annual. So it's an APR, an annual percentage rate. Very important that you remember that, because this is what confuses a lot of people when you're dealing with financing, whether it's for a mortgage or for some other sort of financing, whatever type of loan it is, you're almost always given an annual percentage rate, not a monthly percentage rate. So if we're trying to calculate out this month's interest, which is what we're essentially going to be doing here, you have to divide it by 12. So we divide that by 12, and that gives us our interest for the month. Specifically, our first months of interest. So we start off with our initial balance, we multiply it by the annual percentage rate, we divide that by 12, and that gives us our month 1 of interest. Now we need to find not only how much money is going towards interest, we need to also figure out the principal amount. Well, that's where our payment is going to come in here, because remember, the payment that we break down, and this goes back to that first section before we went on the first break. So if you missed that, go back in the recording and rewind through that and definitely watch that, because this understanding will help you with solving the rest of these questions. You got to build a good foundation of understanding, then you can work on the more intricate stuff like solving these math problems here. So we have to start off with our payment amount. So we take our payment, then we subtract our month 1 interest, and then what you're left with is month 1 principal. So this first calculation figures out our month 1 interest. Our second calculation figures out our month 1 principal. A real easy way to check your work here is just to make sure the 2 of these add up to your payment amount, which it should, because all you're doing is taking this number and subtracting it from the payment. So when you add that number back in, you should be back at your payment amount. Your payment for the month, without talking about, and remember, we're not factoring in the taxes and insurance. That's part of an impound account, which is completely separate here. We're only dealing with the principal and interest. So what we just did, this math here, will give us for this particular month how much money is going towards principal, how much money is going towards interest. But now let's say we need to go beyond this and figure out what month 2 is, what month 3 is, or really figure out what our calculations are going to be for the next month, anywhere we are in this timeline. And that's where our third step comes in. So what we do in this third step here is we're going to carry down this balance. So our balance that we started off with, we're going to carry that down. So we're going to do balance minus principal, our principal payment. So we take our balance that we started off with, we subtract out our principal, because what is our principal? Our principal is how much we just paid down our first month in payment. This is how much we paid for that particular month, how much we decreased our mortgage balance. So we take out our mortgage payment that we made, our principal payment. It's not the entire payment. It's not when you pay a $2,500, you write a $2,500 check to your mortgage lender and your balance goes down $2,500 for next month. That would basically be free money, and it wouldn't really make a whole lot of sense for the lenders to do that, to give out this free money. The reason why they exist is because they're able to make a profit on loaning out money. It's a win-win situation, because the homeowner gets money they probably wouldn't have had otherwise, and the lender is able to make a profit through interest. And maybe those scales are kind of weighted in a different direction depending on the situation, but that's the way that this whole system and this whole financing world works. So we take our principal payment, and then what we're left with is our new balance. In this case, when we just did month 1, this is going to be our month 2 balance. So we have our month 1 interest, our month 1 principal. We subtract how much principal we just paid down, so that's going to be this number carried down here. We take the interest. The only reason we're figuring that out is to figure out how much is left out of our payment. After we pay the interest, you have to pay the bank first. You pay the interest first, and then what's left over is going to decrease your balance. So we carry down that principal payment. That gives us our new balance for month 2. So once we have our new balance now for month 2, we could start all over again. We take our new balance, multiply that by the APR, divide that by 12. That gives us our first month's interest. Then we basically work through these 3 steps all over again. So it's really just a matter, because you can see the math is really easy. We just have some multiplication, division, and then some subtraction, but that's it. It's really just a matter of picking out the correct information, which, like I said, practice with some word problems, and that'll definitely help you out for extracting the information it is that you need. And then just remembering these 3 steps and knowing where to plug in the correct information. So if you're able to do that, it's overall not very difficult at all to figure out these amortization types of questions. So let's go ahead and plug in some numbers with this here. Let's say that we want to figure out, based on this $300,000 loan, 5% interest, $2,500 a month, what these numbers would all calculate out to be. So let's go ahead and do that right down here below this little line. So our first step, we're going to take our $300,000 I know we're getting smaller on here. If you're having any issue watching this, make sure you have it turned on in high definition. We do broadcast this in 1080p HD, so you don't miss anything that we're writing up here on the board. So make sure you have the HD turned on. You'll be able to make out all these finer details of this here. So you take your $300,000 balance. You multiply this by our 5% APR. Now, very important that we have to take this interest rate, this interest percentage, and turn it into a decimal. So we're going to multiply that by 0.05. We move that decimal place 2 places over to turn our percent into a decimal, so that's going to be 0.05. We then divide by 12, and that's going to give us our month 1 interest. So let's go ahead and do a quick calculation here. We're going to plug in these numbers, $300,000 times 0.05 divided by 12. This gives us $1,250. So for our first month's interest, $1,250, which out of a $2,500 payment, we have a pretty big chunk going towards our actual balance. This is typically not the case, because usually this number is going to be a lot higher for month 1, but we do have a low interest rate and we do have a considerably high monthly payment, so that's causing this to be low. So what we're going to have next here is we're going to take our payment amount, our total $2,500, we're going to then subtract our interest we calculated out, which was $1,250. So we'll do $2,500 minus $1,250. And that should, yeah, that is correct, yeah. So it's 50-50 really what we're paying, so we're starting off in a good place. So this is where understanding this amortization is really good, because you might have a pretty sweet deal where only half of the money is going towards interest. Normally this isn't the case. I just pulled these numbers off the top of my head. Who knows if these would really work in the real world, but if you see something like this where you have the same amount of money going towards principal as well as interest, especially for month 1, that's going to be a really good place to be. So that's why, like I said, it's really good to understand this. You could find out if that makes a lot of sense, because now ownership is making a lot of sense in this case here. Usually this interest number is going to be higher, but for this particular calculation, they actually add up to be about the same. So we have $1,250 going towards interest, $1,250 going towards our principal. So for our final step, to figure out month 1 for our total new balance, once we pay this $1,250, we're going to take our $300,000. We're going to subtract out our $1,250. Remember, we're carrying down our principal payment, so we're subtracting out this $1,250. So even though we paid $2,500 for our mortgage payment, half of that money went towards interest. The other half is what's going towards our principal balance. And it won't always work out this nicely with these numbers where it's half and half. You'll see, especially when we get to month 2, these numbers are going to be a little bit more uglier, a little bit more difficult to work with here. So we take our $300,000, subtract out our $1,250. So we're going to punch that in our calculator. And don't always trust your mental math, especially on the exam. You don't want to just trust yourself to understand these, to make these calculations, because your mind will play some tricks on you and it'll make some mistakes, and it's a silly mistake you don't want to make. You're allowed to use a calculator on your exam, so make use of that, even though this is just simple math here. So we'll take our $300,000. We subtract out our $1,250. Yep, and you can see how I could, the calculator could even lead me wrong. Make sure you're doing this a little bit slower than I am, or you'll punch wrong numbers like I did, which showing your work will help you avoid those errors. So we end up with $298,750. So $298,750, that's our new balance. So after we pay our first month's payment of principal, we're not decreasing our $300,000 by $2,500, we're decreasing it by $1,250, which brings our month one balance down to $298,750. So this is month one. Now, typically these questions, they ask you to go out to at least month two, sometimes even month three. So let's keep working this a little bit further. Now, when we go into month two, we're not starting off with the $300,000. This is called compounded interest. Compounded interest means that they recompound, they recalculate the interest every time it is that you decrease that principal balance. So now for month two, your interest isn't going to be based on $300,000 like it was here. It's going to be based on the new balance of $298,750. So we'll start all over. We go through these same 1, 2, 3 steps again, except for we're having new numbers here. We have $298,750. Again, we're going to multiply that by our interest rate. Unless this is an adjustable rate mortgage, which you won't see that on your pre-licensing exam at least, it's always going to be a standard fixed interest rate, so it'll just be that 5% the whole time. But in the real world, if this is an adjustable rate mortgage, this number could, in theory, change. But for now, we're just going to leave this as the 0.05. We're going to divide that by 12. And now here's a real quick way to check your work to make sure everything you're doing is correct here. So let's go ahead and plug in these numbers here. We have $298,750. We're going to multiply by 0.05, the 5% interest, and then divide that by 12. And now this number should always be lower than your first month interest. Remember, your interest always goes down, your principal always goes up. So and this is, like I said, the numbers got a little bit uglier on us here, which is typical with these types of problems. For our month two interest, this is our second month we're dealing with down here. Remember, this is month one, this is month two down here. So for our month two interest, we have $1,244 and about 79 cents, and we do a little bit of quick rounding. There's some left over there. Your bank might round that up on you, but we have 79 cents there that is being charged for interest in this first particular month, or second month. So now to go on and figure out how much our principal payment, because if we're paying less interest, remember, we're paying the same $2,500 every single month. This is a level payment plan mortgage where that $2,500 is the same every single month. So if we're paying less interest, that means our principal number should always go up. And that's how this should always work out, especially with exam questions. Unless you have something called negative amortization, which you won't see that on your exam for calculations, this number will always go down. Your interest will always go down, your principal will always go up. The reason why is because this number is less. We're taking less money out of the payment. So we have $2,500. We're going to subtract out our $1,244.79. So we'll punch that in our calculator, $2,500 of our month two monthly payment, which is the same all the time. We subtract out our $1,244 and 79 cents, and we get $1,255.21 for our month two principal. So this is good. It checks out because we went up by about $5 that we're now decreasing in month two. In the first month, we decreased our principal balance by $1,250. In month two, we're going to decrease our principal by $1,255.21. So this number should always go down, which it did. This number should always go up, which it did. Our simple logic checks out, and it looks like we're doing everything correctly here. Now, our last step, and this is, again, just to kind of round this all out, typically with the exam questions, they're going to probably ask you month two, what is the principal or what is the interest for this, but it could ask you for month three, which, again, we're just going to repeat these same steps over and just plug in the new number that we'll have for our new starting balance. And that's really the only thing that's changing as we go down here. All the other numbers changed subsequently due to that, but this is really our only number that's changing. Our balance is decreasing month over month. So let's just go ahead and round this out for our last step here. In month two, we had $298,750 as our starting balance, and our ending balance on our mortgage is going to be $298,750 minus our $1,255.21 monthly payment. So we'll go ahead and plug that in, $298,750. Very important that you take this number, not from month one, because we're already done with this month one when we get down to here. So now we're dealing with our month two starting balance, and subtract out our $1,255.21. and we get $297,494.79. So our new balance is $297,494.79. I know my handwriting is getting a little bit slop here as we get lower and lower here. I'm kind of having to do the limbo as we write in these numbers here, but hopefully you can kind of follow along with all this stuff here. Really what we've been doing, it all started off with these basic steps. We have our balance. Here's our balance, and here's our balance. This is what we're getting to is our new balance, and that's ultimately what we're figuring out at the end. That's what we're starting the month with. This is what we're ending the month with. We have our principal payments, which should always be increasing. So here it's $1,250, here it's $1,255.21. We have our interest, which should always be decreasing. So that should always be going down. Our interest should always be going up. Our principal should always be going up. Interest always goes down. Principal always goes up. Our stuff that's holding constant is going to be our interest rate. That doesn't change. Our monthly payment doesn't change. So all these pieces are all staying the same throughout this. So it does seem like a lot, and that's why it's really great that these are recorded, because you could rewind through this. If you're watching this on YouTube, you could even put me in slow-mo and really slow me down to like half speed, where I'm really kind of doing this at a much slower pace, which is good, especially if this is the first time that you're going through this. If this is the first time you're seeing these numbers, you're probably feeling overwhelmed right now. I know it is a lot of information, but really once you practice this a couple times, it really becomes second nature to you, these different steps that you have to do with the information it is that you have to look for. So that is amortization. If you guys like today's episode, make sure you hit the like button, make sure you hit share this out to your friends, subscribe to us if you're on YouTube, like our page if you're on Facebook, so you stay up to date, because every Wednesday at 12 noon Eastern Time, we're doing these Ask the Instructor segments. And anyone could watch this show. If you do want to send in a question for us, whether you're in our online course or our classroom course, you do have to be one of our students. Even if you're in our exam prep course, you could send in these questions, and every week we try to answer as many questions as we can on these Ask the Instructor segments. Today was a really big segment all about mortgage financing. Like I said, take advantage of the recording that's available online completely free. Again, you don't have to be one of our students to check out that recording. We're hoping you like the information that we're giving out to you, and even if you didn't choose us for your initial license exam, we know you'll be back to choose us for your post-licensing, continuing education, broker licensing, and all that, because like I said, no other school does more for their students than the Tampa School of Real Estate. I thank you guys so much for tuning in today. It definitely means a lot to me. It means a lot to all of us here at the Tampa School of Real Estate. Like I said, our students' success is really what helps propel us forward. We want to see you successful on your licensing exams, as well as successful in your new real estate career. Definitely give us a call if you have any questions about any of this stuff. Phone number is 813-928-0106. I'm John Carissimo, and I hope you enjoyed this week's segment of Ask the Instructor. Make sure you tune in on Friday at 12 noon Eastern Time. We're going to be doing a show called State of Real Estate, and this one's more about masterminding. There's a really great couple of episodes we've already done on this. The last one was on real estate farming. I definitely recommend you check that out. You can find that in our Success Center, but definitely tune into that. If you want to come back next week, we're going to be here same time, same place, 12 noon Eastern Time. I'm John Carissimo, and you've been watching Ask the Instructor. Thanks for tuning in.
When you look back on your real estate career, you'll remember the moment you decided to begin this journey. The moment when you finally decided it was time for change. The moment when you decided it was time to take charge. The moment that changed the direction of your life forever. Now is that moment.
Hey, I'm John Carissimo, and I'm here to tell you about State of Real Estate. This show is going to be live every Friday at 12 noon Eastern Time, and this is going to be a show for you guys to chat in and get interactive live with us to help mastermind and build your real estate business. So make sure you tune in this Friday at 12 noon Eastern Time. Again, that's Fridays at noon Eastern Time. You can find the links in the description for this video. Look forward to hearing from you on Friday.
After the show, be sure to visit tampaschoolofrealestate.com. Again, that's tampaschoolofrealestate.com, where you'll find all the information you need to start your career in real estate. Also, be sure to check out our Success Center, where you'll find helpful tips for building a successful real estate career.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching.